Hey there, ready to dive into a classic? Today we're cracking open The Warren Buffett Way by Robert G. Hagstrom.
Oh, a great choice.
It's practically a Bible for value investors and for good reason.
Hagstrom really nails it in laying out how Buffett approaches the market.
Right, from picking companies to managing risk and building that long-term value, it's all there.
It is, and here's the thing, it's not rocket science. So we're going to break down those key insights in a way that anyone can grasp, even if you don't speak fluent Wall Street.
Exactly, and to kick things off, how about a bit of a brain teaser?
I love a good brain teaser. Lay it on me.
All right, at the 1987 Berkshire Hathaway meeting, Charlie Munger, Buffett's longtime partner, posed a question to the shareholders.
Okay, I'm all ears.
He asked, if Buffett's approach is so simple, why do so few people replicate it successfully?
It's a question that still resonates today, doesn't it?
It really does. So what's the deal? Why aren't we all mini Buffetts by now?
Well, one roadblock is the sheer dominance of modern portfolio theory, or MPT, as it's known in the finance world.
Okay.
It's the reigning champ in academia and on much of Wall Street. But for value investors like yourself, its limitations are pretty glaring.
Okay, so let's unpack MPT a bit. What's the core issue here?
The central problem is that MPT assumes investors are allergic to risk, or at least the kind measured by price volatility.
Okay.
So big price swings are seen as inherently bad, something to be minimized above all else.
But doesn't that contradict Buffett's whole approach? He sees volatility as an opportunity, right?
Exactly. Buffett focuses on the inherent worth of a business, its intrinsic value, tuning out the market's daily noise. MPT, on the other hand, gets bogged down in those short-term fluctuations.
Right.
You see, it all started with Harry Markowitz back in the 1950s. His work on portfolio selection was groundbreaking, but it also introduced this idea of variance as the main measure of risk.
Variance. So basically how much a stock's price jumps around.
That's it. And the higher the variance, the riskier the investment, according to MPT. Then, in the 1960s, William Sharpe came along with the concept of beta. This further cemented the focus on price volatility as the defining characteristic of risk.
So for folks following MPT, a stock that's on a roller coaster is super scary, while a steady Eddie stock is seen as safe. But Buffett flips that script entirely, right?
He does. He argues that focusing on short-term price movements distracts from the real goal, understanding the long-term value of the business.
Right, yeah.
In fact, he famously challenged this whole notion of risk in his speech, The Super Investors of Graham and Doddsville.
Ah, the Graham and Doddsville speech. A classic takedown of the efficient market hypothesis.
Exactly. In that speech, Buffett points to a group of investors who consistently beat the market, not by following MPT, but by adhering to a value investing approach. They weren't afraid of volatility, they embraced it.
It's like he's saying, hey, look at the results. The proof is in the pudding.
Exactly. Real-world evidence trumps abstract theory every time.
I like that.
Now, we can't talk about MPT without mentioning Eugene Fama and his efficient market hypothesis, or EMH.
Right.
It argues that stock prices already reflect all available information, so trying to beat the market is a fool's errand.
Right. But Buffett argues that markets are efficient, but not perfectly efficient.
Exactly.
There are still opportunities for skilled investors who can dig deeper and uncover hidden value.
Precisely. It's not about outsmarting the market, but understanding it better than the average investor. And that requires a deep dive into a company's fundamentals. Now, let's see this philosophy in action. Hagstrom highlights several of Buffett's most successful investments, starting with the Washington Post Company.
Okay, so it's the early 1970s, and the Washington Post is just one of 5 newspapers vying for readers in D.C. Not exactly a sure bet, right?
Right, and the market certainly thought so. By 1973, the company's stock had plummeted to $23 per share amidst a broader market downturn. But Buffett saw something that others missed. He wasn't looking at the day-to-day stock price, he was looking at the underlying business.
He saw a company with a strong market position, low capital requirements, and the ability to raise prices without losing customers. Basically the trifecta of a Buffett investment.
Exactly. Even in a struggling industry, he saw the inherent value of a company like the Washington Post.
Yeah.
He understood that a dominant local newspaper, even a so-called third-rate one, could be incredibly profitable.
It's like having a captive audience. Everyone in town, every business relied on that newspaper.
You got it. It was a license to print money, essentially. Low capital requirements meant they could easily turn revenue into profit. And then there's the impact of Katharine Graham's leadership, which can't be overstated.
Right. She made 2 game-changing decisions. Hiring Ben Bradley as editor, which led to iconic journalism like the Pentagon Papers and Watergate, and bringing Warren Buffett himself onto the board.
Those moves were transformative. Bradley brought journalistic integrity, and Buffett provided business acumen. Under their combined leadership, the Washington Post Company flourished.
And did this investment live up to Buffett's famous $1 premise? The idea that every dollar of retained earnings should translate into at least a dollar of market value.
It absolutely did. Between 1973 and 1992, the company's market value went from $80 million to $2.63 billion. For every dollar of retained earnings, they created $1.75 of market value for shareholders.
Now that's what I call a return on investment. It shows the power of finding well-managed companies with a lasting competitive edge.
It does. And speaking of finding gems, another fantastic example is Buffett's long-standing love affair with GEICO. This one's almost a love story.
Right, this goes all the way back to 1950 when Buffett was a student and became so intrigued by GEICO that he took a train to their headquarters in Washington, D.C.
He spent hours grilling the only manager on duty that Saturday with questions. Now that's dedication.
Talk about going the extra mile. So what was it about GEICO that captivated young Buffett?
It was their straightforward, direct-to-consumer business model. By cutting out the middleman, GEICO could offer lower prices than its competitors. A classic Buffett move, finding value where others see only simplicity.
It's that cost advantage that Buffett loves, finding companies that can do more with less.
Exactly. But GEICO's journey wasn't all smooth sailing. In the mid-1970s, they faced a near-earth experience, nearly going bankrupt.
Right, yeah, they'd relaxed their underwriting standards to chase market share.
Yes.
And ended up with a portfolio of bad risks. Plus, inflation was wreaking havoc, driving up the cost of repairs and medical care.
It was a perfect storm. They tried to grow too fast and taken on too much risk.
But that's when Jack Burns steps onto the scene, a true turnaround artist.
He was brought in to save GEICO in 1976, and he implemented what he called Operation Bootstrap. Imagine raising capital, negotiating reinsurance deals to offload risk, and slashing costs all at the same time.
He was closing branches, laying off employees, and pulling out of unprofitable markets. A tough but necessary medicine.
Absolutely. Byrne was decisive and relentless in his efforts, and crucially, he was brutally honest with regulators and shareholders about the company's challenges. No sugarcoating, no spin.
He famously compared GEICO's situation to a pilot telling passengers, "The bad news is we're lost, but the good news is we're making good time." Dark humor, but effective.
Byrne understood that honesty and clear communication were key to rebuilding trust.
And it worked. GEICO made a phenomenal comeback, proving the strength of their core business model.
And Buffett's faith in that model never wavered. He understood that as long as people had cars, houses, and boats, they'd need insurance. The demand was practically guaranteed.
It's what sets him apart, that long-term view. He doesn't get spooked by temporary setbacks if the underlying business is solid.
He's looking for those enduring businesses, the ones that will be around for decades. Now, GEICO's success story wasn't solely due to Byrne's operational turnaround. Another key player was Lou Simpson, their chief investment officer.
Right, Simpson was a kindred spirit, sharing Buffett's value investing approach.
Yes.
He focused on companies with high returns on capital, strong management teams, and a commitment to shareholder value.
And he was a master at avoiding what Buffett calls the institutional imperative.
Right.
That tendency for large organizations to follow the herd and make irrational decisions.
Simpson was a contrarian. He wasn't afraid to think differently and find opportunities that others were overlooking.
His track record at GEICO is a testament to that. From 1980 to 2004, he generated an average annual return of 20.3% for their investment portfolio.
That's compared to a 13.5% return for the S&P 500 over the same period. He was crushing it.
Absolutely. Simpson's success further reinforced Buffett's belief in the power of value investing and finding the right people to manage capital. Now, let's shift gears and look at another iconic Buffett investment, Capital Cities ABC.
This one's all about the power duo, Tom Murphy and Dan Berg. They ran Capital Cities with an almost obsessive focus on cost control and efficiency.
Yes, their disciplined style was very appealing to Buffett. He saw in them a shared aversion to waste and bureaucracy.
They were kindred spirits, running a mini Berkshire Hathaway before it was cool.
A perfect analogy. Their business approach mirrored Buffett's. Find undervalued assets, improve operations, and allocate capital intelligently. Their landmark move came in 1985 with the merger of Capital Cities and ABC.
That deal was a masterclass in negotiation and strategy. Murphy, known for his shrewdness, brought in Buffett to help secure financing.
And Buffett, always on the lookout for a good deal, was happy to provide the funds. He saw the potential of this merger and trusted Murphy's ability to create value.
It was a bold move, a smaller, more disciplined company taking over a major network, a sign of the changing media landscape.
It was, and it paid off handsomely. Post-merger, Capital Cities ABC thrived. Murphy and Burke implemented their cost-cutting measures and streamlined operations.
They were famous for running a tight ship.
They were.
They even sent out memos reminding employees to turn off the lights when leaving a room.
Exactly. They understood the importance of sweating the small stuff. They also prioritized returning capital to shareholders through dividends and share buybacks.
It's clear Buffett was impressed. He once said that Murphy and Burke weren't just great managers, but exactly the kind of men you would want your daughter to marry. High praise indeed.
A glowing endorsement from the Oracle of Omaha. And just like with the Washington Post Company and GEICO, Buffett's investment in Capital Cities ABC proved to be a winner.
So what are some of the key takeaways from these three investments?
First, they highlight Buffett's laser focus on undervalued companies with strong competitive advantages. He's not chasing fads, he's looking for businesses that will stand the test of time.
He's not trying to time the market, he's letting the market come to him.
Right. Second, these investments underscore the importance of strong management. Buffett looks for leaders who are honest, competent, and shareholder-friendly.
Yeah.
Stewards of capital aligned with his long-term vision.
They need to be playing the same long game that he is.
And finally, these examples show that patience and discipline are essential. Buffett doesn't panic when markets decline or businesses face temporary challenges. He keeps his eye on the prize, long-term value creation.
Exactly. He understands that real wealth is built slowly and steadily, not through quick flips or risky bets. We've covered a lot of ground already, but there's still more to explore.
There is.
In the next part of our deep dive, we'll look at two more of Buffett's iconic investments, Coca-Cola and Apple. Stay tuned.
Looking forward to it?
Welcome back to our deep dive into the Warren Buffett way.
We've been exploring how Buffett built his investment empire.
Right.
And now it's time to turn our attention to two more of his most famous bets, Coca-Cola and Apple.
Okay, Coca-Cola. This one seems almost personal for Buffett, right? There's that Americana heartland feel to it.
It does have that classic American story element to it.
Right.
Buffett's connection to Coca-Cola goes way back to his childhood. He actually used to sell bottles in his neighborhood, witnessing the brand's early popularity firsthand. But what's interesting is that he didn't invest in the company until much later in his career.
So what changed his mind? What made Coca-Cola a Buffett investment in the 1980s?
A new CEO, Roberto Goizarreta, took over in 1981
Okay.
and initiated a significant turnaround. He focused on streamlining operations, selling off non-core businesses, and revitalizing the company's international growth strategy.
So Goizarreta was like the catalyst, the one who unlocked Coca-Cola's true potential.
Exactly. And Buffett saw this transformation happening. He recognized the enduring power of the Coca-Cola brand, its global reach, and its potential to churn out consistent profits. It was the realization of that durable competitive advantage he always emphasizes.
The kind of moat around a business that makes it really tough for competitors to chip away at market share.
Precisely. Coca-Cola had a product that people loved, a distribution network that spanned the globe, and a brand that was recognized everywhere.
Right.
These factors combined to create a formidable barrier to entry for any would-be rivals.
And Buffett wasn't shy about betting big on that moat.
He wasn't. Starting in the late 1980s, he began accumulating a large stake in Coca-Cola, eventually making it one of Berkshire Hathaway's biggest holdings.
Okay, so let's break down this investment. What were the key factors that Buffett was analyzing?
Well, he started by digging into Coca-Cola's owner earnings. This is a metric that represents the actual cash flow a company can generate for its owners. It paints a much clearer picture of profitability than simply looking at net income.
It cuts through the accounting noise and gets to the heart of how much cash the business is actually generating.
Right. And Coca-Cola's owner earnings were impressive and, importantly, consistently growing. That's a sign of a healthy and sustainable business. Then, Buffett looked at their return on invested capital.
This measures how efficiently a company is using its money to generate profits, essentially how much bang they're getting for their buck.
Yes, and Coca-Cola was excelling in this area too. Their high return on invested capital meant they were generating significant returns for every dollar reinvested back into the business. That's music to Buffett's ears. He loves businesses that can compound returns over time.
It's that snowball effect he's always talking about.
Exactly, and Coca-Cola's ability to do this year after year made it a prime target for a long-term investor like Buffett. Now, here's where things get really interesting. Buffett bought Coca-Cola when it was trading at a significant discount to his estimate of its intrinsic value. It was like buying $1 for 50 cents.
A classic value investing move. He was patient and waited for the right opportunity. He wasn't chasing momentum or trying to time the market.
He was letting the market come to him. And fast forward to today, Coca-Cola is still a core holding in Berkshire Hathaway's portfolio. It's been a remarkably successful investment, generating billions of dollars in profits for Buffett and his shareholders.
It's a testament to that long-term, value-oriented approach, even in the often turbulent world of the stock market. Now let's shift gears to Apple. This one might seem a little surprising considering Buffett's historic aversion to tech companies.
It does seem a bit out of character, right? He famously avoided tech stocks for decades, arguing that it was too difficult to predict their long-term prospects. He even joked that he wouldn't invest in a company if he couldn't understand what they were selling.
So what was the aha moment? What changed his mind about Apple?
Well, it appears that
Yeah.
Buffett recognized the sheer power of Apple's brand, its fiercely loyal customer base, and that incredibly sticky ecosystem of products and services. Once you're in the Apple universe, it's hard to leave.
It's more than just the products, it's the whole experience, that seamless integration between devices and services.
Exactly. And Buffett saw that Apple wasn't simply a hardware company anymore. They were building a comprehensive platform that encompassed everything from phones and computers to music, payments, and even healthcare.
It was that shift towards recurring revenue streams, that subscription model, that made Apple so attractive to Buffett.
Right. And he also recognized the exceptional leadership of Tim Cook, who had taken over as CEO after Steve Jobs. Cook had proven himself to be a skilled operator, guiding Apple to new heights.
He's also a master at capital allocation, aggressively buying back Apple stock and increasing their dividend, which has created huge value for shareholders. It's like they're taking a page out of the Berkshire Hathaway playbook.
You could say that.
Yeah.
So when did Buffett start buying Apple?
It was relatively recently, in 2016.
Okay.
He started accumulating shares, and by 2018, Apple had become one of Berkshire Hathaway's largest holdings.
And it's been a phenomenal investment.
It has.
Apple's stock price has skyrocketed in recent years, driven by their relentless innovation, loyal customer base, and expansion into new markets and services.
It's interesting how Buffett, who initially avoided tech companies because of their unpredictability, found one of his most stable and profitable investments in that very sector.
It's a testament to his ability to adapt and evolve his strategies over time. He recognized that Apple was no longer a risky tech startup. It was a global powerhouse with a durable competitive advantage and a proven track record of success.
It shows that even the greatest investors can learn and recognize a good opportunity when they see one, no matter what preconceived notions they might have. Now, before we wrap up our discussion of Coca-Cola and Apple, there's one more key concept we need to touch on: retained earnings.
Ah, yes. Retained earnings, the unsung hero of long-term value creation.
It might sound a bit dry, but I have a feeling it's more exciting than it sounds.
You're right. It's absolutely crucial to understanding how Buffett thinks about building wealth over the long term. Do you remember Edgar Lawrence Smith, the author who had such a profound impact on Buffett's investment philosophy?
Yeah, his book, Common Stocks as Long-Term Investments, was a real game changer for Buffett.
It was, and one of Smith's key insights was that retained earnings, when reinvested wisely by skilled management, act like a compounding machine, steadily driving the intrinsic value of a business higher over time.
It's like planting a seed and watching it grow into a mighty oak tree.
A perfect analogy. And throughout his career, Buffett has consistently sought out companies with a proven track record of reinvesting their earnings effectively. He looks for companies that can create that snowball effect, compounding returns for the benefit of their shareholders.
So it's not enough for a company to simply make money. They need to know how to use that money effectively to generate even more value.
Precisely, and that's where analyzing a company's return on invested capital becomes so important.
Because a high return on invested capital indicates that the company is getting a good return for every dollar they reinvest. They're not wasting money on projects with mediocre returns. They're finding opportunities that generate significant profits.
Exactly, and those profits fuel the long-term growth of the business, ultimately benefiting shareholders. Now, think back to the examples we've discussed: the Washington Post Company, GEICO, Capital Cities ABC, Coca-Cola, and Apple.
Right.
These companies have all consistently demonstrated a knack for reinvesting their earnings wisely.
They're not sitting on piles of cash. They're putting that money to work, expanding operations, developing new products, buying back their stock, or increasing dividends.
Exactly, and that's a major reason why they've been such successful investments for Buffett. They understand the power of compounding, they prioritize finding high-return opportunities, and they have the discipline to stick to their strategy even when the market gets jittery.
So what does all of this mean for us, the everyday investors who aren't Warren Buffett?
It means that we need to shift our focus away from the short-term ups and downs of the market and instead concentrate on the long-term fundamentals of the businesses we invest in.
We need to look beyond the stock ticker and try to understand how a company generates cash, how they allocate that cash, and how they're using it to fuel future growth.
Absolutely. It's about understanding the business, not just picking stocks.
It's about thinking like a business owner, not a speculator.
Exactly. And it's about having the patience to let compounding work its magic. Remember, Buffett didn't become a billionaire overnight. It took decades of disciplined investing focused on those companies with durable competitive advantages and a consistent ability to reinvest their earnings effectively.
The Warren Buffett way isn't just a set of investing techniques. It's a whole mindset. It's about thinking long-term and focusing on intrinsic value.
It is. It's about recognizing that true wealth is built steadily over time through the power of compounding and the intelligent allocation of capital. Now, in the final part of our deep dive, we'll explore the crucial role of retained earnings in Buffett's investment approach and discuss what it means for you as an investor.
Welcome back to the deep dive. We've been exploring the Warren Buffett way.
We have.
And in this final part, we're going to connect the dots between Buffett's investment philosophy and this concept of retained earnings.
You know, it's fascinating how this seemingly simple idea of retained earnings
Right.
plays such a pivotal role in Buffett's approach to building wealth.
It really is.
It's all about understanding how those retained earnings, when managed effectively, can drive the long-term value of a business.
You're right. It's not just about profits. It's about what companies do with those profits.
Exactly.
And that's where things get really interesting.
Exactly. It's not enough for a company to simply generate earnings. They need to know how to deploy those earnings effectively. And this is where Buffett's focus on return on invested capital, or ROIC, comes in.
So a high ROI means the company's generating a strong return for every dollar they reinvest back into the business. They're essentially making their money work harder for them.
Precisely. They're not throwing money at low-return projects. They're carefully selecting opportunities that have the potential to generate significant profits. It's about being smart and disciplined with capital allocation.
And those high returns, when compounded over time, can lead to incredible growth and wealth creation for shareholders.
Absolutely. Think about it like this. Compounding is like a snowball rolling downhill. It starts small, but as it gathers more snow, it gets bigger and bigger, gaining momentum as it goes. Retained earnings, when reinvested wisely, can have that same compounding effect on a business's value.
It's a powerful concept,
It is.
and one that's often overlooked by investors who are too focused on short-term gains.
You're right. Too many investors are chasing the next hot stock or trying to time the market instead of focusing on the fundamentals of the businesses they're investing in.
Now, think back to the companies we've discussed in this deep dive. The Washington Post Company, GEICO, Capital Cities ABC, Coca-Cola, and Apple. These are all prime examples of companies that have a long history of reinvesting their earnings effectively.
Exactly. They haven't been content to sit on piles of cash. They've consistently put that money to work, whether it's expanding their operations, developing new products, buying back their stock, or increasing their dividends.
And that's a big part of why they've been such successful investments for Buffett. They understand the power of compounding, they prioritize finding high-return opportunities, and they have the discipline to stick to their strategy even when the market gets jittery.
Exactly. Well, they're playing the long game, and that's a key takeaway for any investor who wants to follow in Buffett's footsteps.
So as we wrap up our deep dive into the Warren Buffett way, what's the most important lesson for our listeners?
I think the biggest takeaway is this. Investing isn't about gambling or chasing quick riches.
Right.
It's about understanding the businesses you're investing in, having a long-term perspective, and being patient and disciplined.
It's about thinking like an owner, not a trader.
Exactly. It's about finding those great businesses that can compound their value over time and then letting them do their thing. Remember, Buffett didn't become one of the wealthiest people in the world by trying to get rich quick.
Right.
He did it by being patient, disciplined, and focused on the long game.
And by understanding the incredible power of retained earnings.
Absolutely. So to all our listeners out there, whether you're just starting out in your investing journey or you're a seasoned pro, remember this. The principles that have guided Warren Buffett to success can guide you too. It's not about being Warren Buffett. It's about thinking like him.
Well said. I think that's a great place to wrap up our deep dive into the Warren Buffett way. Thanks for joining us.
It's been a pleasure.
We hope you've learned a thing or two about the Oracle of Omaha's investment strategy. Until next time, happy investing.